Hi, Justin Davey here again. I've just done a video on speccing my new BMW M140i, and actually as I was making the video at the end, an idea for another video came upon me, and that was to talk about the finance and purchasing behind cars. It's something that I'm very interested in. It's something that frustrates me a lot, to be honest, because often I've been into dealers, and dealers, no disrespect to dealers, they've got a job to do, but they've also got a product to sell, and often they will, I think, try and pull the wool over the customer's eyes. And because I've been doing this for quite a while now, I actually know quite a lot about the finance behind cars, and so I thought I'd put this video together to talk about different options, to talk about APR, to talk about flat rate, to talk about voluntary termination and stuff like that, that the average member of the public might not be familiar with. And it frustrates me when people aren't getting the best deal that they could do. And so that's what this video is going to be about. So this is totally off the cuff, it's not scripted. So I'm going to be using a product called Finance Calc. It's a free online website. Sorry, I've just realised I forgot to start my screen recording. Okay, so hopefully this is now recording. Yeah, so there's a website called financecalcs.co.uk, and it's brilliant. It is a really good tool for calculating what loan repayments are going to be, but also for calculating early settlement figures, and it's about right. In my experience, it differs slightly, but it's pretty spot on. So I'm going to be using that as a demonstration today. Okay, so let's start by talking about what a PCP is. PCP is probably the most common way of financing a car. Now, I in the past have used PCP. I've also used personal loans. I've battled with whether PCP is a good way of buying a car or whether it's not a good way of buying a car. I've been there. I've done so many different options for financing cars. You know, I'm 40 now and I've probably bought 20 cars plus over the last 20 years or so. From BMW, from Audi, from Porsche, you know, I've from Mercedes. I've dealt with a lot of premium brands. And so I think I'm fairly well qualified to try and help people who are looking at buying cars. So PCP, personal contract plan, personal contract purchase. What does it mean? Well, it basically means that, and this is something that I didn't realise at the beginning. It basically means that you buy a car, you pay a deposit, you finance the rest, and then you have what they call a balloon payment at the end. The first thing to realise about a PCP is that it's not a lease. It's a finance plan. You own the car technically. It's exactly the same as a hire purchase agreement, but the main difference is that, say let's take a 48-month agreement. After 47 months have passed, instead of month 48 being the same amount as all the previous month payments, it's much larger. HP is basically where you pay 48 equal months. Now, obviously, when you pay over a traditional HP agreement, your monthly payments are going to be higher because every month is the same. And by month 48, in our 48-month example, you have paid the entire amount of car off. So you own the car. The difference with a PCP is that you are paying a deposit, which is entirely up to you how much you pay. You're then paying in a 48-month example, you're paying a 47-month period of equal payments, and then you are offsetting a much bigger payment to the end. Now, that is sometimes called a balloon payment. It's sometimes called a GFV, which is guaranteed future value. The advantage with a PCP is that you've got lower monthly payments. So let's just have a look on the screen here. So this is Finance Calc. So this is a total finger in the air example. Let's say we are buying a car for £30,000 and we are putting in a £1,000 deposit and we are financing over 48 months. Let me just zoom in a little bit so you can see this a bit clearly. more clearly. And let's say this, I'll come back to what flat rate and APR means in a minute, but let's say we'll take a reasonable APR of 4% flat, and ignore these because a lot of finance agreements years ago used to have quite a high first payment. They used to charge something like, I don't know, £125 admin fee when you started the agreement, and then there was an option to purchase fee. That seems to be going away a bit more, and that can alter the APR. So I'm going to assume that there's no option to purchase fee and no arrangement fee in this example. And let's say on a £30,000 car, we've got a balloon payment of £10,000. Now, what that means is that a good thing about a PCP is that you are protected. So a dealer will give you a GFV, a guaranteed future value. So they're saying that regardless of what happens, providing you've taken reasonable care, fair wear and tear of the vehicle, and providing you have agreed, you've not exceeded a certain amount of mileage, we'll come to mileage in a minute, the car will be worth £10,000. So we calculate the loan. So this tells me, look over here, that we have borrowed £29,000 because we've given a £1,000 deposit, and our APR is coming out at 7.7, and our monthly payments, we've got effectively 47 monthly payments of £530.97, and then at the end, at month 48, we've got to give them £10,000 to own the car. Or it might be that the bottom's fallen out the market and your car's only worth £8,000. Well, rather than saying, well, actually, I'm going to give you £10,000 to own it, I'm going to give it you back. And they take the risk. All PCPs, whenever you take a PCP out, make sure it's a regulated agreement, and that will mean that it's covered by the Consumer Credit Act, which means that you can hand it back. And I'll talk about voluntary termination in a minute. But effectively, what this is saying is that the guaranteed future value is £10,000. You've made all your payments. It's only worth £8,000. You can give it back. So, interesting. So that's basically what a PCP is. Now, whenever the first thing I would say, notice here, I put in a flat rate of interest of 4%. But it's telling me the APR is 7.7, and that is vital. Whenever you go to buy a car from a dealer, I'm not saying they do it all the time, but in my experience, dealers will give you an interest rate, and they will say something like, oh yeah, we can get you a great interest rate, we can do this at 3% or 4%. Let's say we'll do it at 3.9%. And you go, oh, fantastic, that sounds good. The first question to ask is that flat or is it APR? Because often they will quote flat rate to make it sound better than it is. And as a rule of thumb, obviously it's not quite that here because we've got a balloon payment, but on a rule of thumb, the APR is twice the flat rate. If you work as that as a rule of thumb, you know where you're at. So if a dealer is telling you 3.9 and you say, well, is that APR or flat? And they say flat, you can go, actually, that's about 7.8 APR, which isn't that competitive. If the best rate you can get is 6.9, 7.9 APR, I would tend to, if you can, if you've got a reasonable credit rating, go to somewhere like Tesco Bank. They'll give you 3.9, 3.8, probably less than that. I haven't looked for a while. But on new cars, there's an incentive to buy a new car to get more new cars on the road, and the finance company will tend to give you a better rate. If you're looking at a used car on a PCP, be very careful, because I've seen rates as high as 12% APR, 10.9% APR, and it's not worth doing. Let's just take an example. Let's say I was buying a used car and it was, I don't know, $15,995, and I'm going to put a £1,000 deposit in, 48-month term. And from what I've said earlier, let's say it's a 12%. Let's say it's a 10.9 APR. So as a rule of thumb, let's put 5.5 in the flat rate. And 15,995 over 4 years, you're probably going to have a balloon payment of not a lot, 5,000. Let's work this out. Now look at this. 10.6 APR. Pretty close. I said a rule of thumb, halve it. Let's whack that up a tiny bit. Let's go to 5.7, 5.65. There you go. So 5.65, we bought a car at 15,995, we put £1,000 deposit in, so we're financing 14,995 at £303 a month. Sounds reasonable, £300 a month. But look what we're paying. We're paying £4,276 in interest alone, and our total amount payable on that 15,995 is 20,200. That's quite a lot for a used car, you know. So I wouldn't do that. I wouldn't bother personally. And you want to try and get that interest rate down. Let's say we knock it down to 4% flat. It's knocking it down £24 a month. Look, our interest charges over the 4-year period has dropped to £1,000, and we're on 7.7. Now that's still pretty high, but it's reasonable for a used car. Okay, the interesting thing is now, so we've covered PCPs. The next thing I want to cover is settlement. So I'm going to take an example, something that's very similar to my BMW M140 on my previous video. Let's say my purchase price is £31,000. We'll stick with no deposit to begin with, 48-month term, and it's a 2% flat rate. It's a very good rate at the moment on used cars, new cars, and that's why PCPs on new cars can work quite well. Something I didn't mention is actually, let me just, sorry, I know I'm flitting about, but let me just go back to that previous example. What was it, 5.65? There, look. The interesting thing which I didn't point out, look, is our balloon payment that we owe at the end is almost the same as our interest that we've paid, which is ridiculous, really. That's why it doesn't work very well on a used car. Going back to my new car example. So let's take a cost of £31,000, deposit of 0, 48-month term and a 2% flat. Now, on a 48-month term on a new car, because you can get a lot of discount on a lot of new cars. Bearing in mind that my car was getting on for 40,000 retail, because I've got negotiated a big discount. The balloon payment isn't that bad. The balloon payment is 14,118 on my car. So we're only really financing, what, £17,000? The important bit to remember on a PCP is, which going back to what I said earlier, I didn't realise years ago, is that a dealer might say, oh well, you're putting your deposit in and you're financing this bit and then you've got this bit at the end. Don't forget that you're paying interest on all of the amount borrowed, not just the bit between the deposit and the final value. So if you've got quite a high final value and a high APR, you are paying interest on that final value that you're not doing anything with. So just bearing that in mind. But with a 3.9% APR, as you can see, look, I put a 2% flat in, coming out at 3.9 APR. It's not actually that bad. Now look at the charges. I've borrowed effectively £31,000 because remember we're paying interest on the balloon payment as well. The total charge £3,500, which is less than the £15,995 used car at a 10.9 APR. So that is actually pretty good. They're only charging you £3,500 to borrow 31,000. Right, this is interesting. So our monthly payments, look, are £433.19. Let's see what happens when we put in a deposit of £1,000. Brings it down £23 a month. Now you could go, well, okay, well I don't want a big monthly payment. I want a monthly payment of £350. So let's say, I don't know, I'm guessing here, let's put 4,000 in. That's not a bad example. So I'll put £4,000 down to bring my monthly payment down from 433 to 341. So what, 90 quid a month? But you've got to find £4,000 in deposit, which is quite a lot of money to find that you could do with something else. You could put it in the bank and get a bit of interest on it. Now the interesting thing is, because you've got a balloon payment at the end, your settlement figure is hardly ever going to be different, regardless of what deposit you put in, after about the first 12 months. So what I'm going to do, look, is go into this tab called Settlement Calculator, and I'm going to look at what the settlement figure will be on this term. So we are financing 27,000 and our monthly payment is 34142. So let's put it into here. So loan amount 27,000, term 48 months, first payment 34, I've forgotten what it was, 34142. 34142. And then remember our balloon payment, our final payment is 14118. Tells me, look, that it's 3.9. Let me just make sure I'm right. Yeah, 34142. So look, so I've put £4,000 deposit in. Now this tells me what my settlement figure is at any point. So let's say after 2 years we decide we want to get out of it. Now don't forget that a PCP, as I said earlier, is the same as an HP agreement. You can settle it any time. You can ring up the finance company, say what do I owe, give them the money and own it. You could sell the car. You could pay it off that way. Just be careful about selling a car that's got finance on it, because that's quite tricky. But you can always settle it. So you could ring up any time and say, what do I owe on a PCP? So let's say after 24 payments, so 2 years, we want to know what we're going to owe. Roughly, and again, it will change a little bit, but we would owe £20,767.90 to get out of that agreement. Okay? Now, bearing in mind, we've put £4,000 in and we owe 20,767. Let's see what we'd owe without putting any deposit in. So going back to the loan calculator, no deposit, monthly payment 433.19. Okay, so let's go back to our settlement calculator. So finance 31,000, 423.19, 423.19, and the settlement before, look, was 2767. Now look what we owe after. Oh, so I'm wrong there. 433.19. Right, 22,812. So yes, it's higher. We owe more because we put no deposit in, but we don't owe £4,000 more. We owe what? I can't remember what it was now. 27,000. What was it? 3, 4. I can't remember now. Was it something like that? 3, 4. I don't know. This is a guess, but it's about 2,100. So what I'm saying is, yes, you owe £2,100 less to settle, but you don't owe £4,000 less to settle. You put £4,000 in at the beginning. You've paid less per month, fair enough, but you still owe £2,000 less. You owe £2,000 less, not £4,000 less. So if you can afford the cash flow, I would put 1,500 quid in. Let's try it with 1,500 quid. 398. So that's nice. Let's keep it under £400 a month. 398.78. So we're going to be financing 29,500. 398.78. 398.78. Yeah. So settlement 22,045. And we've only put £1,500 in. So what I'm trying to say is, and it might not be coming across very well, but what I'm trying to say is, don't think that if you put a big deposit in at the beginning, you're going to get all that deposit back. Because the longer you run it for, obviously by the time you get to say month 42, 6 months before the end, because the final value is always 14,118, regardless of how much deposit you've put in, you're gradually meeting that final value. So you're never going to get that £4,000 back. So if you can afford the extra £50 a month, I would do that than put in a big deposit. The last thing to cover is the difference between flat rate and APR. Okay, so flat rate is basically the amount that you would pay per year. So let's say you borrow £1,000 and you had a flat rate of 10%, you would pay £100 every year for every £1,000 that you borrow. So if I borrow £1,000 over 2 years, I'm going to pay £200 in interest on a 10% flat. But you have to remember, that's assuming that you are owing £1,000 for the whole year, but you're not, because you're paying it down. So you owe £1,000 in month 1. If it's a straight HP agreement, you owe nothing at the end of month 12. So flat rate gives you an indication of, you borrow £1,000, flat rate 10%, you pay £100 in interest. But the reason that APR is usually twice that amount thereabouts is because APR takes into account that you're paying it down as well. So let's take our £1,000 over 1 year. You owe £1,000 at the start, you owe nothing at the end of month 12. So if our interest charge was £100, then effectively you take the average point of what you owe. So if we I'm trying to explain this, if we have an interest charge of £100 over £1,000, that's 10% flat. But if we paid £100 in interest over £500, because remember, we're paying it down, so effectively halfway point of a 12-month period, we don't owe 1,000 anymore, we owe 500. So we take that point, 500, and we take our interest of 100. Well, what's that? It's not 10%, it's 20. And that's where, roughly as a rule of thumb, the doubling comes from. Now we can work out monthly interest rates. I might do another video on that. That's where you take things like the APR and work out the 12th root and all sorts of things. It gets fairly complicated. But like I said, as a rule of thumb, always ask what the flat is, and then you can roughly double it to get your APR rate. The last thing is voluntary termination. Now, voluntary termination, if you buy, an advantage of buying on HP or PCP is that if it's a regulated agreement, and there are agreements out there that aren't covered by this. I had a friend once who bought a car through Santander and they wanted to get out of it, and we looked through the small print and it actually wasn't covered by the voluntary termination regulations. So just make sure it's a regulated agreement. But what the voluntary termination says is that providing you have paid 50% of the total amount financed, including any deposits you've made, you can walk away from that car. Now don't get confused between half term and half amount, because I've read on some forums that some people think, oh well, I've had a 36-month agreement, I've paid 18 payments, I'm going to give it back. Doesn't work like that. Certainly with a PCP, because obviously if you've got a big offset at the end, a big balloon payment, there's no way after month 18 of a 36-month agreement you will have paid half down. So it's half the amount. Let me give you an example. So let's say we are borrowing £30,000 with a deposit of £2,000, flat rate of 2% and a balloon payment of 14,118. This is the important bit when you're looking at voluntary termination. Total amount payable, 33,242. Okay, that's your amount you've borrowed, £30,000. Your interest charges and any deposit you've made. Okay, so 28,000 look, plus your £3,242 interest is 31,242.92 plus the £2,000. That's the important bit. So if you want to work out whether you can hand your car back or not, look at your finance agreement, look at the total amount payable and divide it by 2. So I'm going to get my calculator up here, which is here. So let's have a look. So in this example, our total amount payable is 33,242.92. Divide that by 2. So if we have made payments of £16,621.46, we can hand it back. So let's say we have made, actually what we'll do, we'll take the halfway term point, so 24 payments. So let's take our monthly payment, 24 months times 364.36 is 8,744, and then remember we can add a deposit on. So our deposit was £2,000. we've made payments of £10,744.64. We can't voluntarily terminate, yeah, even though we've paid 24 payments, and that's because we've got that massive balloon payment. So let's work out when we can get out of it. So total amount payable 33,242.92 divided by 2, 16,621.46. Take off our deposit of 2,000, 14,621.46, and then divide that by our monthly payment 364.36. We can get out of that. We can voluntarily terminate just after month 40. So maybe go to month 41. So you could get out of that 7 months early. Now, what voluntary termination means is that if you've got a car, say our car was only worth £12,000, and let's say our settlement figure was, I don't know, let's say we're at month 36, so it might be £17,000 to get out of it. You've got to sell the car for 12 grand and also give the finance company £5,000 to get out of it. However, if you're at this point, you can say, okay, well, I've made 41 payments, have the car back. And they can't really do anything about it. They don't like it, but you can walk away. You ring them up or you write a letter, and there's various standard letters online, things like moneysavingexpert.com, and they will come and pick the car up. They can't charge you to collect the car. And one that is a very interesting thing that I'm kind of researching at the moment is whether they can effectively pro-rata the mileage charge. Now, we haven't talked about mileage. What mileage says is when you take a PCP out, you estimate roughly what your yearly mileage is going to be. So let's say it's 8,000 miles a year. And they will say, for every mile you go over that, we will charge you 8p a mile. Let's make it easy. Let's make it 10p a mile. That's pretty high, but let's make it 10p a mile. So let's say at the end of the term, the end of the whole agreement, 48 months, you want to give the car back, and you've done 40,000 miles, and you signed up for 8,000 miles a year over 4 years, which is 32,000 miles. So you're 8,000 miles over. So what they will do is charge you 8,000 times 10 pence. So they will charge you £800. So you can't just give it back. And that's when that is enforced. A way around it is if you're going to buy a new car, is go to the dealer a couple of months before, get a part exchange value, trade it in, and do it that way. The dealer will have some kind of incentive to get you into a new car, and they'll usually try and get you out of it. The mileage charge only comes in, firstly, if the value of the car is less than the guaranteed future value. So if it's not, it won't come in. But if it is, they will charge you an excess mileage, because obviously the car is worth less and they need to auction it off and they need to get rid of it somehow. The question is if you voluntarily terminate, so let's say we're going to voluntarily terminate at month 41. So we should have done 8,000 miles times 4, 32,000. So, and if they're going to pro-rata it, at month 41, so that's 41/48 times 32,000, you should have done 27,300 miles-ish when you give it back at voluntary termination. If you've done, say, 30,000, they could say, well, actually, you owe us, let's assume it's dead on 27,000. You can voluntarily terminate, but you also owe us £300 to walk away. There is a fair and tear section of a finance agreement. Basically, yes, it's going to have a few scuffs, but providing you've taken reasonably good care of it, it's regularly serviced, it's not completely trashed, they should take that car away and you should walk away from it. There are finance companies who will try and get a pro rata mileage excess charge out of you. And I don't know which is right or wrong. There are some arguments on forums that say they can't enforce it. There are some arguments that say they'll try and enforce it. If you want to fight it, you can. But really, I don't know. But technically, if they pro-rata mileage it, that's how you work it out. But that's how you voluntarily terminate. So, are there any downsides to it? Well, I've read that there will be a mark on your credit score, but all it will say is that the agreement was ended somehow. It won't say whether you ended it or whether the finance company ended it. And I've read loads of articles that say you'll still get finance again. You know, you can voluntarily terminate, and then you can take finance out with the same dealer again. I've read some people that have voluntarily terminated 3 or 4 times and it's not made any difference. But it's there. It's really there not to be abused. It's there to say, well, I can't afford it. I've fallen into hard times. I've paid more than 50% of the total amount payable. I'm going to give it back. But, you know, there's an argument to say, well, I've had this car 3 years out of a 4-year term. I've reached my voluntary termination point. It's worth £5,000 less than I owe on it. I want to buy a new car. Well, why would you trade it in and have to find another £5,000 before you start again? You could voluntarily terminate and start again that way and have a clean slate. I think that's everything. So important bits are a PCP is the same as an HP. You can get out of it anytime. You can pay it off anytime. Excess mileage charges apply, but only really at the end. Always ask what the flat rate of interest is when you're going for a car, and then you can work out what the APR is. Don't put a big deposit in if you can, because you'll lose that deposit whenever you settle. You'll never get that whole deposit back. I'm sure there's other things I'll think of in another video, but I hope that was useful. If there's any questions you've got about voluntary termination, about APR, about how you work things out, please comment below, and I'll see you again soon. Thanks for watching.